What happens to my business taxes in bankruptcy? Have you ever wondered what happens to your business taxes when you file for bankruptcy? This is a common question, and understanding the answer can help you navigate this challenging situation. When your business files for bankruptcy, the handling of your taxes changes significantly. Let's break it down in simple terms. First, bankruptcy is a legal process that helps individuals and businesses manage or eliminate debts they cannot pay. For businesses, the most common types are Chapter 7 and Chapter 11. The tax outcomes depend on the type of bankruptcy you choose and the structure of your business. Once you file for bankruptcy, a new legal entity called the bankruptcy estate is created. This estate may need to file its own tax returns if it has enough income. The person managing the business during bankruptcy, known as the trustee or debtor-in-possession, must obtain an employer identification number for the estate. They will also need to file the appropriate tax forms. If the estate's income is below the standard deduction for a married individual filing separately, which for 2020 is $14,600, no separate return is needed. The bankruptcy estate can choose its own tax year, but this period cannot exceed 12 months. The trustee can change the accounting period once without needing approval from the Internal Revenue Service. This flexibility can help manage the estate's tax responsibilities. A common concern is whether bankruptcy can eliminate tax debts. The answer is sometimes yes, but not always. Certain older income taxes may be discharged if they meet specific conditions. For example, the tax must be due at least 3 years before the bankruptcy filing, and a return must have been filed at least 2 years prior. Taxes for which no return was filed, or those from more recent periods, typically cannot be discharged. Penalties and interest on tax debts are treated differently. Penalties that are more than 3 years old might be discharged, even if the underlying tax cannot be. However, interest is usually only dischargeable if the tax debt itself is dischargeable. Another important point is about cancellation of debt income. If a creditor forgives a debt, the Internal Revenue Service usually considers this as income. However, if the debt is discharged in bankruptcy, this income is generally not taxable. This rule applies to both individuals and businesses, making bankruptcy a beneficial option in some cases. However, certain tax attributes, like net operating losses and tax credits, may be reduced, which can impact future tax bills. It is essential to remember that bankruptcy does not automatically erase all tax obligations. You remain responsible for taxes that do not meet the criteria for discharge. If you have unfiled tax returns, those taxes are usually not eligible for discharge. It is crucial to file all required returns and consult with a tax professional to understand which debts might be eliminated. Late payment penalties that are more than 3 years old may be discharged, but this is not guaranteed, especially if there is a tax lien. Interest on tax debt is generally only dischargeable if the tax itself is dischargeable. Understanding these rules helps business owners make informed decisions about whether and when to file for bankruptcy. Keeping accurate records and filing tax returns on time can affect which debts are eligible for discharge. Bankruptcy can provide relief from overwhelming debt, including some tax obligations, but it is not a complete solution for tax problems. Careful planning and professional advice are essential to navigate the process effectively.